Good evening, and thank you all for coming on this early winter's evening. It's a very important year for us at Platinum. It's exactly 20 years ago that we set ourselves up, having left Bankers Trust. At that stage, there were 4 analysts and 3 support staff. 3 of the founders are here, myself, Andrew and Liz. Andrew Clifford, who you'll meet in a while, and Liz, who you met earlier. And gradually the team's built, and we now have 30 investment staff and another complement of around 60. And it's changed a lot over the time. So what we saw was initially we had a single group who acted in concert and brought through ideas. And what we found is as the team grew, it became more and more difficult to communicate. And so Andrew's done a wonderful job in the last 3 years to break the big team into a set of 5 other teams, smaller teams, each with a focus on specific industries. And the virtue of that is the younger folk get the benefits of the wisdom of the others, and they get enough attention to train them and bring them through. And also the whole streamlining of the process has been very beneficial. And in addition to those folk, we have the quantitative team and the execution team. Now, the quantitative is interesting because you can imagine if you look at the world markets, there are actually many thousands of companies, and we would say there's at least 7,500 which are of interest to us. And it's by using quantitative methods that you can start narrowing down the field of investigation. Because remember, what we're trying to do is get rid of those things that have become very popular and trying to buy those things that are still under a cloud. So we're now running something like $23 billion, and what of it? Well, as the video suggested, had you come in the early days, 19 years ago, your 10,000 would now be worth slightly more than 100,000, which compares with the consumer price index, which has probably gone up a bit more than twice, so it's doubled a bit more, and the average manager's probably given you 2.5 to 3 times your money as an international fund. So there's a big gap. But let's just think about the context of this last 20 years, because so many of us say, well, like when starting a business, when is the right time to invest? And there's never a good time, in my experience. There's always some doubts, there's always uncertainty. That's the nature of buying assets that are other than cash deposits and term deposits. So, when you look back at this 20 years, what you see is a period of astounding volatility. Back in the great days of the tech boom, 2000, the NASDAQ exchange went up 110% in its last 12 months. Then you think of the GFC, the global financial crisis, as we call it in this country. The banks were definitely under threat. Our banks somewhat less than others, but nevertheless the government stood behind them and guaranteed their bonds and so on, as well as deposits. Markets fell 60%. So it was a pretty interesting period, and many of us were certainly concerned. So when you think of other setbacks, such as the problems we had in Asia back in 98, and you think of the problems with the euro in 2011-12, they really looked like blips on the scale of in the scale of things. And that's where it comes to this whole notion that we're talking about tonight. It's about time, renewal, and composition. Because what's really happened in this last 20 years is there's been a complete transformation where the world has opened up. 20 years ago, it was extremely difficult to get any real access to markets such as China, the mainland. Brazil was open, but not that open. Russia was not. And in this 20 years, there's probably only one country that has not adopted the price mechanism to set the allocation of resources. Turning that into English, hitherto we had bureaucrats in some countries deciding how much of something should be produced and who should get it. In all those countries that were formerly communist, they are now using the market mechanism to determine who gets what and how much to get paid. It's a huge change. And with it, of course, there's come the internet, which has intensified competition, and the fact that we now have access to markets globally. That's also intensified competition. But we now have a globe that is huge. It is a much bigger market than we ever had before. And yet, we in Australia are still sort of caught a bit in the past because we're taking our holidays abroad. We realize that Aussie's not exactly cheap, and yet with our capital, we're not really fleeing abroad as we are with our holidays. So there's an ambiguity there, or a paradox. So we're living in this world of relative rationalism, with perhaps one exception, which is the pricing of money. So in some countries, we are suppressing the short-term cost of money. So we are actually obviously interfering in the system because of this huge overborrowing virtually everyone engaged in. And as with any other binge, the aftermath is often quite painful. The world cannot grow as quickly as it had, simply because we're trying to pay down this debt. And the mechanism we're trying to use is to have prices move up, perhaps pay down some debt, but in terms of the amount of debt out there in relation to a bigger economy, it diminishes over time. So to just give you a real example of this, and it's drawing on my memory. So after the war, Britain had about 4 times debt to GDP. But simply by having some growth and about 3% inflation in the first 7 years after the war, debt to GDP dropped to about half, and then it dropped again. Growth dropped, but there was a little more inflation. So there is a mechanism that allows the gradual expunging of the percentage of debt, not necessarily the total of debt, but it's the proportion of debt drops down. And gradually that allows the system to heal. But as I said in this video, so often we get told, people will tell us about these wonderful companies and we will be very boring and say, well, what is in the price of that company? Is that price already reflecting the hopes and enthusiasm of investors, or is it actually at a discount and expectations are low? It's when you have a gap between expectations and reality, you can either go long or short. And our preference is to try and find companies where there's a gap that is in our favor to go long. So please don't believe our job is to find the finest companies in the world. It is not. If you wanted that, you could do it yourself. Just go to any list of leading companies in the world and pick the top 5 in each major market, and you'd probably have some of the finest companies in the world. But would they be fine investments? I suggest they may not be, because the prices may already reflect that excellence, and then you have no arbitrage. So what our job is, perversely, is to actually control our emotions. And we would be delighted if our investors did, because we talk about giving you 13% compound over a long period of time, but what we actually find is that our average client has earned about half of that. Why so? Because they invariably come in well past the danger zone. In other words, it's already market's well up. And then once the market's got to a peak, they tend to stay. And then when things are really getting quite bad, they decide to leave. So they don't get the full benefit of the ride. And the message I'd love to try and convey is the virtues of having some sort of savings scheme. You can put $200 in a quarter, but at least that smooths out your excitement in every respect. But also the virtue is that you don't then become obsessive about, oh, I went in at this price and look what's happening, and you become all sort of concerned. So now I have a question. if you were able to know what was on the front page of the financial pages of tomorrow's paper, either regularly or irregularly, do you think it would actually help you systematically make money? We suspect it wouldn't, and I'll show you why we think that's true by choosing several phrases that were very popular by looking at Google trend words. So what we're using here is Google search, and they identify when certain terms or words are getting very high usage. And these words are subprime, financial crisis, and quantitative easing. So let's start with the first one, which is subprime. So as you can see, there's a huge build-up in enthusiasm for this word, and it reached a peak in about mid-2008. And now if we superimpose the blackguard of the event, so-called, Mr. Lehman, you'll see that the market was actually lagging. You'd already seen the stock fall quite a lot. And as I like to tease, I'd say, well, even a chartist would have done better than the headlines. And you look at another frequently used phrase, which was financial crisis, but that came upon us quite quickly. And September 2008 was the peak. And look what happened to the S&P index over that preceding few months. It fell by around 500 points or 30%. So thinking about headlines as a guide to our decisions, let's just take it to a more recent event, which is quantitative easing, which has been receiving quite a lot of attention, and then superimpose the 10-year bond in the US. I suggest to you it's just a trailing indicator. It is not a valuable method of determining where markets are or what they're going to offer. Invariably, things have already changed by the time they get full headline coverage. And some of you will have read our quarterlies in the build-up to the financial crisis, and you'll know we talked a bit about the slicing and dicing of these instruments. And that really was the cause of the financial crisis. So when people say to us, oh, no one could have predicted this, we get a little anxious because, in fact, hard work was quite evident to anyone who did the work. It was evident that the system was starting to fall apart. And our analyst at the time was emphasizing the importance of this segregation. And it was important because, as we so often know, it's never difficult to find people to borrow money. It's finding people who will borrow money and then repay it. And what we had done is we had set up this idea of having originators of loans, so-called mortgage agents or originators, and they were quite discreet from the people who were actually offering the funds. And when we melded the two, we then had these pieces of paper which we split up into all structures. So some were going to get capital back, some were going to get some income and some capital, and some might get some capital but could also get this. And the consequences were dire. So far from being a mystery to anyone who was watching what was going on, work showed through. But here's a point I'd like to leave you with on this subject, and that is that in the coming months, it's quite possible that the headlines will be blaring on about slowing growth in China. Chinese are actually taking some remedial action, but that's the sort of thing you could expect to come through. So here I am removing one prop that you might have used to bring some order to your thinking and your investing. What am I going to give you as a replacement or something in return? May I suggest the best measure we can offer is looking at long spreads of history. And if we go to one of the bigger markets of the world, the US, we can give you the returns from shares going back from the 1870s. So here we've got about 140 years of data. And to make some use of this data, what we've done is we've looked at the best consecutive 5 years, the best run of 5 years of returns, and also looked at any of those periods where you've had the worst period of 5 years, and we've presented it as a bar chart. So as you can see, the best period was you were getting returns over 5 consecutive years well into the 20s. That was your best return, which happened to peak out just before the crash in 29. And the worst 5 years was the period up to 34. And as you can see, you lost about 60% of your money. It dropped about 12% compound over that period. So it was an interesting period. Now, let's then take the best 10 years of that 140-year period and the worst 10 years, and you'll see a different pattern starting, a slightly more moderated pattern occurring, where the prospects of loss are much diminished, and yet the gains are also diminished somewhat, but still pretty meaty. And so you add a third bar, which is 15 years. The average stays at around 9% compound over this long period of history. But the prospect of loss, there has not been a 12-month or December to December period where we've actually lost money over 15 years. Now, there's a little gilding here, and I must be open with you, because this is your total return. This is your dividends and your capital appreciation. So you basically, over 15 years, you're getting a small cash return in the worst situation, but generally you've had some pretty decent returns. But over 20 years, you're doing fine, and so on. So the important point here is that so many clients and people one meets socially start fretting about retirement in their 60s and saying, well, how much money should I have in shares? But if you look at that, it's quite likely that you've got a 15-year horizon at least. And just the way the system is tilted these days, I suggest that equities are an interesting proposition. So where have you actually ever completely had a wipeout from being in shares? Well, there are a couple of big countries where that has happened, and that's where you've had regime change. So the two that come to mind are China and Russia. China in 49 and Russia after the Bolshevik Revolution in 17. So there are instances of wipeouts, yes, but in wars, you don't necessarily have a wipeout. So if you look at places that have been pretty badly damaged by war, so you think of Japan and Germany, it really is quite instructive. So here you might have been a serviceman in the Wehrmacht, you come back in 1945, or if you were on the Eastern Front from about 54 from Russia, and your house was probably in ruins, your street was probably obliterated, but your equities, so long as you were in the west of Germany, were giving you quite a decent return. And of course, subsequently, it was the miracle economy that then took off, as was the case in Japan. So it's an interesting illustration, and it's what we can show. Now, this is the interesting point that I'd like you to think about. We live in this world of huge change. We see innovation, and we imagine companies grow quite quickly. But if you look at my 140-year history of the US, would you be surprised if I told you that the average real change in earnings per share, average real growth rate, so that's not including inflation, was a mere 1% compound per annum over that 140 years. So then you could add inflation, which has been about 3%, so that gives you about 4% return from capital appreciation, and then a running yield of about 4%. So that's where your returns have come from. Many people love the idea that shares are all about growth, and I put it to you that it actually is about the combination of the running yield, which over the last century for all markets, about 34 we have good records for, has been 4.3% per annum. That's been the running yield, the yield from shares in the 34 countries we can identify. So yield is quite as important. If you think back at the 20s, you really got a feel for how everything seemed it was on the cusp of big change. So you think of the US automobile industry in the 20s was producing about 5 million cars a year. It was transformational. Roads were built, suburbia developed, packaging changed because we suddenly were no longer served from behind the counter. We could help ourselves. So we had the supermarket evolve. And then you just had this extraordinary change. We've got the same thing happening today. The internet is a completely disruptive technology for distribution. There are very few locks on distribution now. So we live in constant change, and that's the problem, and that's the explanation why the average company doesn't grow as much as you'd hope, because so many companies are facing creative destruction. This Darwinian competition winnows out the soft and the weak and gives prizes to the winners, who are invariably the aggressive and the strong. So when you look at the great stocks that Warren Buffett, one of the great investors, came up with in the 1980s, companies like Coca-Cola and McDonald's and Procter & Gamble, they were magnificent, but they do have a use-by date, partly because the companies can tire, partly because there's a change in the marketplace, and so on. And it's really quite instructive. I bored you at the start with this discussion about price being everything. So when you think of Coca-Cola, when Buffett bought it, it was under $1 a share. By 1998, so that's 18 years later, it had risen by 40-fold. From 1998 to the present, it has been unmoved. From 40, it's now 41. The trouble was, the price had anticipated a perfect environment and continuing high growth. And indeed, it did continue to grow, but its price-earnings ratio slipped from 41 times to 20 times. Price is critical. So when I was a private advisor in a stockbroker, I remember people used to punish me with these observations about, well, people must eat, and other sort of rather neat solutions to their problem of investing. And I'd explain that that was fine, but sometimes you eat less. So the world is about change, and you can think back at these other miracles that we've seen. You can think back at that wonderful company, Xerox. So you can't take refuge in monopolies. And, you know, right now, you've got problems with Microsoft. The operating system is falling out of general use. I'm a bit of a strong claim, but it's starting to change. It's lost its lock. Cisco, the same. A whole lot of things are changing. And you have to observe what created the opportunity and what is starting to destroy it. And the internet is starting to corrupt some of its strength. But think of these great companies like Xerox. Here was a company which invented this remarkable machine that could put an image on plain paper and could do it at speed. It completely transformed the way we worked in offices. But the problem was that it was such a powerful invention, such a money spinner, that it created this problem within the organization, is they were always trying to reinvent the same sort of incredible money machine. And so even though they had a very powerful science establishment in Palo Alto, which invented things like the mouse and the user interface you now use on a PC and so on, such was the protection afforded to this original idea that no one was prepared to really run with these new ideas, because it was always referenced back to this one great success. And so when you look at companies, you need to understand what drove the success and how are the new managers of that business treating this change? Because my observation is the inheritors often do not fully understand what built an organization, but wear its success as a mantle of excellence about which they know nothing. You need to understand that in companies, because there is that protective mechanism for what has been before. It doesn't really allow for the creativity and imagination to deal with change. And it's precisely this that causes us at Platinum to avoid popular stocks generally, because there are so many other companies in this universe of, let's say, 8,000 companies who are plodding along. They face changes, they deal with them, and it's at that time of dealing with these problems that they seem most vulnerable, because there's the most uncertainty. And that's at that time the press starts going on about, have they lost their mojo? Have they lost their way? It's exactly the time when you have the biggest opportunity, because there's the biggest uncertainty about their future. Most of the time, they're simply going through a pause to refresh. But invariably, there are many people who will tend to misunderstand what is really happening. But for us, it's a much bigger pool of opportunities than simply chasing today's winners. And the way to deal with it, to try and build certainty to the decision, we try and identify what is the core of this company, what is its DNA, what allows it to keep a steady path. And our favorite company, which we've bored you with before, is BMW. So here was a company which by 1939 already had a jet engine fitted to a plane and flying. It was an incredible engineering feat. By 1945, there wasn't anything left. Their best plant had been either bombed or stolen, and all they had is their engineers and this powerful belief in engineering solutions. And they did a remarkable thing. They could no longer make these engines, so they set off on a new path of making cars, and they used a licensed-in product from Fiat and gradually rebuilt themselves, and today produce close to 2 million cars a year and own brands like BMW, but also the Mini and Rolls-Royce. So there's certain irony in all these things. One of the problems we all face, and I know we do, and I'm sure you do, is there's just this information overload. So here we are trying to deal with this deluge of information that keeps coming, and in the internet world it just keeps accelerating, so it's not easy. So we create all sorts of tricks called heuristics to try and take shortcuts. And one of the worst things most of us do is we extrapolate. We say, well, this is how it's been, we don't need to change, it'll stay more or less the same. And it's very dangerous to do that, and we think it's a perfect way to make money, is to go the other way when people are starting to follow the same tread without any thought about possible changes. And the case in point is, as I suggested at the outset, is the Australian dollar. So here we are today. We've just had a remarkable change in the position of Australia. We've had 20 years of unremitting growth. Living standards have grown by about 20%. And it's because of this incredible boom we've had in China. So what we've had is demand for our metals, but not just demand going up, but prices going up. I mean, it's been fantastic. At the same time, the very things we import have been pretty flat in terms of prices. And this is reflected in what we call the terms of trade. So the basket of our exports compared to the basket of our imports is at really a perfect situation. The value of what we sell is much more elevated than what we buy. The problem is, can we think this will persist, or do you think this is going to persist? Our view is it will not. We think back in the time of the Korean War, you had a similar type of lift-off, and then we've waited for 60 years for it to happen again. I suggest this is an unusual situation and unlikely to recur. And it has important implications the way you think about how much you want to have in Australia, how much you want to have outside this country. Now let me give you another set of heuristics that we use, and this is this whole subject we've written about and presented on before, curious investor behavior. And many of us have all these biases, availability bias and association and all these things. But the worst thing that we do is we oversimplify and make connections that don't exist. We have a hunch or something. And when we talk about pharmaceutical companies, that excites people because they generally like the notion that these are necessary products we consume, and as we age, we'll probably consume more. The problem is that's an oversimplification, because I think the story for the drug companies is far more powerful than that. And I'll take you through the logic just to show you the way you can embellish a thought if you just think it through more carefully. So these companies went through a difficult period because their patents in almost all of the companies started to run out, and they had this big drop in their revenues, and they were basically in a difficult way. These, incidentally, had been very popular stocks 10 and 15 years ago, and we'd shorted some of them without much effect. But by the time we started to buy them a couple of years ago, they were selling on 10 or 12 times earnings because of this threat of diminishing revenues. But what was actually happening, these companies were in transformation, so they started to have access to those vast markets I was talking about, Russia and China and Brazil. So their markets went up, but they were now able to address markets that were also facing improved living standards. And with that, you had a change in diets, and they started to, unfortunately, have some of the diseases like diabetes that are prevalent in the West. So the market expanded. Then they addressed their costs, and they used to spend 30% on getting their stuff to market. They now do that at 20% of their sales. So it's fallen by a full 1/10 of their sales in terms of costs. They've also addressed the way they find drugs, new drugs. So it's biotechnology has become more important. They're using other people's technology. It's no longer the pride of if it's not invented here, we can't use it. And their costs are starting to be much more reflective of the market opportunity. Lastly, we would say, and yes, too, they will have a bigger market for the 800 or 850 million people in the so-called developed world. But the real story is just this global reach has changed out of all proportion. There's an interesting movement at the moment which favors indexing. So we have many people saying, well, why should I pay fees to a fund manager? Because they don't do any better than the average, and I'm paying them for nothing. And we're very sympathetic about that and agree entirely. But there's one trap. The index is highly skewed. So at this moment, the world index is made up of principally half is weighted to the US and half to the rest of the world, which would be fine, except remember this: America accounts for less than 20% of world output. In physical terms, it probably produces fewer goods, not services and goods, but fewer goods than China. Remember, China produces 10 times as much cement and 8 times as much steel. So don't underestimate how critical China is to the world and particularly to this country. So China in physical output is probably a bigger economy than the US, but that ignores services where the US is much stronger, obviously. But here's a country that constitutes 49% of the index. And remember, when you're looking at stocks, what you're talking about is the future. You're not talking about the past, you're talking about, I'm buying this for tomorrow's opportunity. Do you believe that half the opportunities over the next 16 years are going to originate in the US? I don't. I do not. particularly when I point out that China, India, Brazil, and Russia, and a few others, account for less than 1/10 of that index. I just think it's completely mad. So, and in case you think I've lost the plot, just remember that the UK in 1900 accounted for 25% of world capitalization. The US at that time, which was clearly the challenger, together with Germany, was 15, Germany was 13, and France rather less. Today, the UK accounts for 8, Germany about 4. So it's been a huge change, and that's the sort of time we're talking about. In the next 16 years, I think a lot will change. So it's for this reason that we at Platinum pay no attention to the constituents of the index. In case you don't know, most fund managers will say, well, if the US is 49% of the index, we should have approximately 49% of our money there, because otherwise we will have a very large tracking error. And by tracking error, they mean their price will diverge dramatically from that core index. We're completely unconcerned about that. And indeed, 2 years ago, as some of you will know to your pain, we diverged dramatically. And we may do so again. Almost certainly we will. But the point is, we have a simple task. We're allocating people's savings. That's the first thing we're doing. And we're doing so to try and make money. So to worry about what are the constituents of an index is just nonsensical in our view. And by the way, if you disagree, there are plenty of managers who will help you with an index fund. So when you think about what we do, we're trying to find those companies going through a difficult patch, difficult as in perception, not necessarily reality, buy those, and gradually stack a portfolio systematically by looking for companies that are out of favor. And over time, you get this sort of stacking effect, and you can make some good money. So if I summarize what we've been thinking about, firstly, price is all important. It's not about the origins of a company or its base or its activity. It's what's the price? When you get jittery and you find the markets collapse, as they can, there's a simple question. It is, has the system been so damaged that it now will take on a different complexion? Because by the time you decide to take your money out after a big 30-40% fall, invariably it is already adjusted. It is too late then, and you need to be quite certain there's a change in the system before you then join the crowds and exit, because that'll cost you money. Ignore the headlines. Fast-growing companies are lovely to find, but the majority of companies go through this periodic setback, which is where the bulk of the opportunities lie in the equity markets. Please, whatever you do, if you see a trend that's developed over many years, make an assessment of whether there are factors that were unique to that period and whether you should extrapolate or not. Most of the time, you should not extrapolate. Avoid oversimplification, and most important, understand the composition of where your risks and rewards lie. And it won't be an index, it'll be about the individual opportunities. So let's look at this world economy. We're not particularly concerned. There are valuations issues in some markets, we concede. But I think, or our feeling is, the world is gradually repairing itself. It is a gradual process. So if you look at the US, they've been given a rather lucky hand because they dealt with the problem pretty quickly. But the most important free kick they've got is this remarkable technology of extracting gas from shale. And it's often oversimplified because this is an extraordinary feat of engineering. What you're talking about is drilling through perhaps 3 kilometers of rock, and then horizontally drilling another 2 or 3 kilometers, placing huge horsepower at the top of the well and fracturing this rock below. You do it through explosives, but then you break the fissures up with a high-pressure water charge. But remember, what you're actually doing is you're breaking material that is similar in strength to that of concrete. So it's an astounding bit of engineering, and when you think of the depths and you think of the size of the holes by the time they're up 5-7 kilometers from where you start, it is tiny. So with this has come not just gas, but the US, which had been a very large oil producer back in the 60s and early 70s, had seen diminishing liquids production, and in other words, oil. But with these gas finds, you're also extracting liquids. So from a base of a couple of years ago of producing about 6 million barrels of oil a day, the country's now getting liquids of about 9 to 9.5 million barrels a day. So it's a huge transformation of both liquids and gases. And so out of that is going to come a huge change in the economy, because you've got low-cost energy. You've also got this rebuilding of their chemical industry, their refining industry, and so on. It's a big, big change. And off that, there's going to be a decent investment boom, and it's already started. So if you look what's happening, banks are lending again, house prices have started to move up, house starts are picking up quite nicely, industrial buildings are picking up. There's a general sense of progression, and importantly, wages are starting to pick up. And in places like the Gulf, where there's such a lot of activity, there's actually a problem with getting people. And this is a mobile country. This is where people do move around. There are trailer parks, there are quick building solutions. So the place will grow. And in our view, the government or the central bank, the Fed, will keep money relatively cheap. And the way we're tending to play the US is we're buying these companies which will be transforming that investment. So they'll be the companies that put in the plant that allows these gases and liquids to turn into chemicals and so on. We also have a large component of our US investment in their interesting companies like Google and so on. So it's a blend of old technology and a new world. Europe is interesting. We've had this extraordinary outcome at this election recently, where basically there's some concerns about too much intervention from Brussels. But the exciting part is just what's happened on the ground. So countries that have been in chronic current account surplus, like Greece, for the first time since 1949, is now in surplus, current account surplus. And you look what's happening in places like Spain. So their exports, which used to be about a quarter of the economy, are now a third. Jobs are slow in coming, I must acknowledge, but there is growth, and in some places you're seeing typical recovery of house prices, wages are seeing some pressure in 1 or 2 places, and it's not all bleak. But it is fragile, but the question is, where are the opportunities? And that's what we spend our time on, looking at rather than worrying about the big economic picture, because basically it's pretty well covered. We see good opportunities in the drug companies, which account for 9% of our portfolio. We see very interesting opportunities for these luxury good companies. They're far from lost their growth credentials. These companies will start growing faster now that the clampdown in China has pretty much revealed the underlying trend of growth in these, the demand for these products. And we like companies like Pernod, which is a drinks company, makes very good profits, and it's a global story. So if you look at the portfolio, we've got about 25% in the States and Canada, and about 25% in Europe. Then you look at Japan. Here's a place which we don't really want to take a view on the success or not of Abenomics. Will they get a change? We think it's highly likely. What we do know is the currency has dropped precipitously and industry is now pretty profitable. So this last year, earnings for the market were up over a third. So it is changing. But the interesting thing to us is what's happening at the corporate level. So very proud companies like Hitachi have swapped assets with what they would have in former years regarded as an inferior company, which was Mitsubishi Heavy, and they've taken the junior role, which is unusual. Similarly, with their rail business, they've headquartered it in Britain. Their IT storage business, so that's memory business, they've headquartered in the States. These are companies which are changing. And now there's a really nasty tweak coming through, whereas there's a special index being formed, and for companies that are not profitable, they're simply eliminated from this index. And that's causing consternation because many of these companies are inherently profitable, but they're sitting on, or half their balance sheet could be cash, or a third of their balance sheet is cash, so they're not getting the return on equity that their American and European counterparts are. So many of them now are talking about buybacks, using more of their balance sheet in a more proactive way. So there's change happening, I assure you. And the companies we have in Japan are the great manufacturing companies which have the technology like Toyota, which is the world's biggest car company. And we love their telecoms business, which is going to probably grow at 15% a year in earnings, which is not going to be easy to find. But of all the big markets, perhaps the cheapest of all is Korea. And of course, the leading company in Korea is Samsung Electronics. Here's a leader in its field. It outsells Apple about 3-to-1 in terms of smartphones, and you can buy it on 7 times earnings. So just for perspective, many of you like the Australian banks because of the dividends. They're typically on 14, 15 times earnings. Here's a pretty interesting global company, which no one had heard of or much about 25 years ago, and now is a giant with 25% of its capitalization in cash on 7 times earnings. And the problem is that the competitiveness in producing these smart devices, pads and phones, is just intensifying. So Joe Lai, who runs the Asian Fund with Andrew, was on the phone to a Chinese producer, and he was pretty intrigued by this company because they'd miraculously produced a pretty decent 4G mobile phone and was selling it for $150. And Joe pressed him and said, well, why are you able to make any money out of this? And he said, well, we just took the punts and went with this new TD system that the Chinese have evolved, and we're first to market, and we're producing, I think it was about 10 million phones a month. So we have an advantage in terms of scale. And Joe said, well, that doesn't seem like a very durable advantage. He said, yes, you're right. He said, so when the competition catch up, we'll cut prices. So the world is just very competitive, but in fact, with Samsung, we think it's largely priced in for a more competitive world in phones. And there'll still be some premium for brands and so on. India, we think, is a very interesting market. We see huge changes coming from this election. We'll now have a prime minister who has a very clear mandate. We see a whole lot of things happening. And by the way, there were already things starting to change if you follow the country under the old regime. So there were already changes in place. So he doesn't start with a blank sheet, and he will now sharpen up the focus on a pro-growth mandate, which is very clear. We can talk about that perhaps in question time. And then you look at China. Now, China is the one place where you're going to hear a lot about the problems. We wrote about this a full year ago, and they're real. I mean, this is a country that is industrialized as no other. It has been a huge stride, and no one can really see or take issue with the successes they've had. But it's been at a huge cost, environmental in particular, and we're seeing the big change now is that hitherto many of the decisions were directed by the government and the provinces. From here on, it's going to be dependent on the individual and the private sector. You can't dictate to those folk as you can to your own employees and so on. So this is the transition, and I think the country will still talk about 7% growth, but it's highly unlikely that will be achieved or achievable. The labour force is now stabilised, it's no longer growing, and indeed there's no country on earth, and certainly not of this magnitude, that has been able to grow when only a third goes to consumption and 48% goes to capital investment. It's just too high. Capital investment must come back as a proportion of the total. So it's a vast economy, and we can see it growing slower, but I will just point out a few things to you. Back in 2000, we had the banking system with around 40% of its loans were non-performing. In other words, people were not meeting their repayment of capital or interest. So it's been through some difficult times. The system's now much bigger and more sophisticated, but they will have some bad debts. Property prices are starting to fall. Property starts are diminishing. They're no longer starting as many projects as they were. There have been some losses from these wealth management products. That's happened, and it will continue to happen in our view. So there's going to be plenty of headlines, but here's the change. Under the new regime, this whole notion of clamping down on corruption is partly to clean the system, but it is also an exercise of power. It's an exercise of power to bully these very privileged state-owned enterprises into changing their activities. They, in many cases, have locked out private competitors. So yes, you can flap about wealth products, you can flap about the changes, but if you look at other countries where they've allowed the private sector to really get a bite on the cherry, you'll be surprised how it can change and bring through a lot more growth than you would otherwise expect. And the current president is very aware of this, and this is the pressure point. And because of all the vested interests in China, because of the structure of the economy and the whole social network, without that pressure point, he would be finding it extremely difficult to bring change to that economy. I believe he has the power and the will to pursue it. And you see it with this chasing down of corruption. You see it by the removal of people, and you see it by questioning of civil servants who have families abroad, and they ask why. So this is a country going through a huge change, and please don't underestimate the desire of people to get ahead. And so yes, there'll be the headlines, but I suggest the place will still grow at a decent rate. So we can take a lot more questions on that, but I don't want to dwell on that. So when you look at where we're positioned today, as I say, we've got about 25% in each of Europe and America, 14% in Japan, and the rest in Asia. Much, much more than most people think is appropriate, and we just know where the value lies. China, the Shanghai index 6.5 years ago was over 5,500. Today it's 2,000. The economy has more than doubled in that 6.5 years. And when we showed you the deterioration in prices in the worst 5 years in the States, it was 12%. The Shanghai exchange over the last 6.5 years has fallen by 14% compound. The market, we believe, is in a pretty serious way discounting a slowing in that economy. So by the time it's in the papers, it's probably too late. It's probably time to be buying that market now. So that's where we've got a lot of money, about 10%. We've got about 5% in India. On currencies, we have no Australian dollars, we have no yen, and we have about 30% in the euro and European currencies, 50% in the US dollar, and then bits and pieces in Asia. So we're about 93% invested, which for us is a pretty aggressive stance, and we have about 14% short. So we're about 80% long the markets, which is quite high for us. We are concerned about some valuations, but that's why we're tending to skew towards these places where the valuations are much more interesting. So if I can now ask Andrew, our CIO, and Jacob, our Deputy CIO, to come and help me answer some of your questions. Thanks very much.
So if you want to ask a question, please just put your hand up, and we've got microphones coming around, so they'll be with you once they see your hand. So.
You clearly differ from Michael Pettis in your assessment of China, which is really interesting. Can you just explain a little bit more where the differences might lie in your view of the possible outcomes there?
We're talking about China and where the differences lie.
Sorry, I couldn't. The sound up here is a bit funny. It was a question about China and our differences with...
Different view to Michael Pettis.
Oh, okay.
Yeah.
All right. I'm not quite sure what his views are, unfortunately, but I think that to sort of restate our position, I mean, it's very clear that the Chinese economy is slowing. The massive investment boom that has driven that economy for the last decade and a half is coming to an end, and a natural end. You just end up with too much cement capacity and steel capacity and so on. And there undoubtedly will be fallout from that. If you've invested in a cement plant, I expect that you're not going to have a particularly pleasant next decade or so in terms of returns from that, would be my guess. If you've lent to that cement plant, you might be also having a few losses that you might be taking. But the economy is much broader than that, and there's a whole range of other areas that will move ahead in the consumer area, and we see this in the internet and e-commerce and so on. But even there, it's very hard to work out, will this new area overtake the losses from this other? So it comes back to what Ker's been talking about all night, and that is the prices that we're paying for stocks, and that they are cheap. So to give you a very simple example, there's a company, Shanghai Auto, which is a Chinese state company. It has two joint ventures, one with Volkswagen and one with GM. These are two of the earliest foreign automakers in the country. They have great positions. And you can buy that company today, that holding company, on around 6 to 7 times earnings. It has no debt. It generates significant cash flow and is giving you a dividend yield of 8%. So that's a good investment, even if auto sales are down for the next 2 or 3 years, I think. And that's really where I think our key difference from most of the people who are very bearish on China is that we're not probably disagreeing very much in the economic outlook. We're disagreeing about the opportunities that are presented to you at the moment to buy stocks in that market at very attractive prices.
Yep. Mr. Kerr, could I ask you to comment about two of your funds, your international fund versus your unhedged fund? Because as you mentioned, you have an 18% short position, and one could assume that gives some degree of protection against market volatility. Is that a reasonable assumption? And in reality, has that actually protected the international fund returns as opposed to the unhedged fund? Thank you.
Thank you for that. Yes, the reason we started the unhedged was to give people the choice of whether they were happy to live with the volatility and if they preferred to have something like the international fund, which tries to remove some of that volatility. So that was the reason for the two products. The problem is that when you follow the course we do, there are times when the market sells off where our funds will sell off a little more. So by having those hedges in place, it tries to reduce that amplitude of that sell-off. But in most respects, the two funds are quite similar, and over time, it depends on whether we make returns from the shorts. But hitherto, in this particular period, it's actually been neck to neck with the two funds. Do you want to add anything?
I mean, if you look at the behaviour of the Australian dollar, it tends to be, sort of inversely correlated to the global stock market. So that's where the unhedged fund, when stock markets are weak in a structural sense, it does tend to pick up a little bit of protection just because it won't be carrying any exposure, any hedging into the currency. And I mean, it's quite remarkable how over a period of time, the swings and roundabouts, the performance tends to sort of even out between the two funds.
Mr. Kerr, you mentioned about the sense of optimism in the Indian market with the change in government. Would you be considering increasing your exposure in your international fund and the Asia fund towards the Indian market? The Indian stock market is probably at its highest peak at the moment, 24,000 to 25,000 points. Do you think there's still any value left there? Would it go higher? And if so, if you're going to increase your exposure, would that be very expensive at this point of time?
So in the Asia Fund, over the course of, the months leading up to really late last year and perhaps a little bit early part of this year, we increased the exposure to India from about 11 or 12% to the order of up closer to 18. And the opportunity there is India's an interesting market because it hasn't been that bad a performer in the scheme of the emerging markets. It's gone sideways for a while, but it certainly hasn't done a China and fall the best part of 60%. So you had this market where you had some we thought very cheap stocks, and they all had something in common, and they really were all companies that were sensitive to interest rates, either because they were a bank or they had lots of debt. And interest rates for even good corporates were of the order of 15% or so. So companies like property developers, infrastructure players in roads and power, ports, these were the companies that were very cheap. And we were buying these, quite enthusiastically up until the period just before the election. Now, many of these stocks have taken off. They're up, from where we were buying them 2 to 3 times, so quite spectacular returns. But in reality, many of them are at prices they were only at not that long ago. So we think actually that there is still very good value in most of our Indian portfolio. Yes, the market is going through to new highs, but as I said, they're not particularly spectacular because we've been at this level for a long time. There was the other part of the Indian market that foreign investors preferred, which were the consumer-type stocks, the Unilevers and the like, that traded on very high multiples. And while we wouldn't particularly argue against them, we think there are certainly much more interesting investments to be had than that. So, look, India is a story where, we really need to just get the roadblocks out of the way so there can be investment. And then I think the extraordinary growth that is possible. It's a country where if you put in a road, if you put in a power station, you give people mobile phone connectivity, you create economic growth. It's as simple as that. But there have been roadblocks to all of those things occurring. And if you take those out, I think the growth can be spectacular and of the order we've seen in China in the last decade. So even though some of those more expensive stocks, like the Unilevers, might actually turn out in the longer term to be quite reasonable investments from this point, I would think. I should also say, I mean, we did take up the Indian exposure in the international fund as well, to the order of, up around 5% in similar sorts of stocks.
Do I go?
Sorry. Sorry.
I'm just wondering, you've told us all these marvellous stocks around the world. So which fund should we buy within the Platinum Group? And then secondly, I thought I read somewhere in one of your articles that you've got a team inside that picks the best ideas of all the other funds you've got inside the group. So therefore that should outperform. Is that the right answer? And give us an idea what you think we should invest in amongst your portfolio of funds. I don't want to hear about India or Japan anymore.
I'm going to be really boring, and I'm going to give the same answer that, I would have given any time in the last 20 years. And that is that the fund we think you should invest in is the international fund. And it's simply, that is the fund where you're giving us the greatest flexibility to put your money where we think the best opportunities are. And the only problem with that answer is that you'll come back in a year's time and tell me that that was a dud answer because this fund or that fund beat it, because one of the other funds always will beat it, because that's the nature of markets. There will be some area that is outperforming over the next, year or 3 years. So then to try and add a little bit, a more useful answer perhaps, is to, if you look at our investment approach, what we think the interesting area to look at is to look at those parts of the market that are underperforming. And if you were to look at our funds and look at the weakest performer in an absolute sense, in recent years, it's been the Asia Fund. So it might lead you to thinking about that as being perhaps the more interesting of the funds outside of international. And that would probably be consistent with the views that, Kerr was, discussing regarding China and India.
For the US stocks, what do you think is the effect, medium and long-term effect of quantitative easing?
Would you like to
I think, internally we just think that depressing the cost of money ultimately leads to some form of capital misallocation within the economy. It's very hard to judge where that's taking place until after the event. But no doubt there is distortions taking place in the US, whether it's the current pattern of companies using the corporate bond market to effectively borrow and buy back their stock. We find it interesting that even though the US has been probably come out of this in the best apparent shape, it hasn't led to, it's leading to a below average employment growth outcome and a below average capital spending cycle. Corporates are more interested in buying their stock than investing in plant and equipment. Now, that is starting to change on the margin, and we have investments that are exposed to North American capital spending. The 3 engineering companies that we own are in the portfolio for that specific reason. It's so depressed, it should recover. And you have the gas, the transformation of the energy efficiency of the economy, and also the fact that labour is just very cheap in the south of the US. So there's a lot of ducks in a row for a decent capital spending cycle, but there is distortions taking place, and no doubt will clearly governments can borrow money cheaply. That's one of the one clear aspect of QE. You could argue that America is slowly repairing in a fiscal sense, but it's happening in it's almost as a result of gridlock in Washington as opposed to a proactive program of budget cuts. But you can see in Japan, Japan's the world's best practice in terms of not worrying about fiscal imbalances, and QE in a way is kicking the can down the road for Japan because it just keeps government bond yields at record lows for longer and means the Japanese government can keep running very large fiscal deficits. So It is, you know, if government bonds were to reprice to sort of the levels that they've been at over, you know, a long period of time, which is more like 5%, a lot of Western governments would be in strife. So distortions, no doubt, are taking place, and we'll find out the consequences in due course.
Justin?
Hi, you talked before about investing in coal seam gas companies. I'm just wondering what's your take on investing in other fossil fuel industries for the future?
We were talking about the benefits from this exploitation of tight gas, not investing in it. We're investing in the companies which will beneficiate those gases into chemicals and the like. As for a strong position on carbon emissions, we have no statement to make because, I mean, these economies will gradually wean themselves off these carbon-rich energy sources, one imagines, but we haven't got any particular exposure to that.
Gentlemen, your presentation has been quite excellent. It's so good, in fact, I want to move all my funds to platinum. Now, something tells me that might be a little bit unwise, but my last financial advisor suggested my overseas investment should be limited to 20% of my total portfolio. Now, I've listened very carefully, and I can understand something of the United States. I know something of the UK. Well, not the UK. I've sort of lost on that at the moment. But certainly Europe. China I know less of. My question is, what percentage would you recommend if it's not 100%?
We have a real problem with giving advice because we don't know your circumstances and so on. For myself, I've never felt that I needed to have all my money in Australia. So I've long invested in the international fund and in fact all the funds, and have, of all the shares I own, I have perhaps 90% abroad and, no, probably 95% abroad and 5% here, but that's a nutter working, so you work backwards from that and you'll be fine. What I suggest is, can I suggest, you'll find, we'll be having some drinks there, and you'll find people with platinum tickers on them, and if they're loitering without intent and have a big glass of beer in their hands, they're invariably an analyst. So I'd be delighted if you'd join us for drinks and do make them pay for their drink. So please do join us, and we're delighted in taking your questions, and we have plenty of time to speak to you all this evening. Thank you very much for coming.